Welcome to The Explainer. Today, we're diving into a really fascinating corporate drama surrounding one of the market's most talked about AI advertising companies, AppLovin Corporation. This is the story of a major market darling that just got hit with a historic shock. We're going to break down exactly what happened, step by step, using the data we have right in front of us. Let's get into it. I mean, it almost defies logic, right? Think about it. How does a company miss its revenue target by roughly 1% only to watch its stock absolutely plummet by 28% in after-hours trading? That is a massive disproportion between a tiny little earnings miss and a brutal market sell-off. So today, we're unpacking this mystery, looking at the situation completely impartially from both sides of the aisle. Here is our roadmap for today. We'll start inside AppLovin's ad ecosystem, move to the Q2 earnings shock, and check out Wall Street's Great Divide. After that, we'll explore both the bull and bear cases, and finally wrap up with valuation and outlook. Okay, let's dive into Section 1, inside AppLovin's ad ecosystem, understanding the AI ad engine. To really understand this crash, we first need to establish what AppLovin actually does. Basically, they're a vertically integrated ad tech company with a super strategic structure. About 80% of their revenue comes from their on-demand platform, which is called App Discovery. The other 20% comes from their supply-side business known as Max. But here is the absolutely crucial part. This forms a closed-loop ecosystem. Because they control both the advertiser demand and the publisher inventory, they get this incredible top-down visibility across every single transaction happening in their network. It's like having a bird's-eye view of the entire highway system, not just one car. Empowering that massive 80% slice of the pie is AXON AI. This is literally AppLovin's crown jewel. It's their proprietary AI advertising optimizer that runs right inside their demand-side platform. It essentially uses machine learning to help advertisers hit highly specific return on ad spend targets. AXON is for sure the growth engine of the company, designed to constantly learn and pump out better outcomes for advertisers over time. Moving on to Section 2, the Q2 earnings shock. A minor miss, a major reaction. So the real catalyst for our story hit on August 5th, 2026, when AppLovin dropped its highly anticipated second quarter earnings. And wow, this is where things get wild. They reported $1.92 billion in revenue. Now, the consensus expectation was $1.94 billion. To put that in perspective, that's a miss of just $20 million on a nearly $2 billion pie. It's tiny. Meanwhile, their earnings per share actually beat expectations at $3.76, and their adjusted EBITDA was super strong, coming in at $1.61 billion, which is a 58% jump year over year. Overall revenue was up 53%, and the underlying business was exceptionally profitable, with gross margins sitting pretty at 88%. But here is the catch. This was the very first time since going public that AppLovin ever missed its own guidance. And how did the market react to that tiny $20 million miss? A staggering 28% plunge in after-hours trading. No joke. Trading volume that day hit 11.4 million shares. That's more than double the 90-day average. What that tells us is that this wasn't just routine profit-taking. This was conviction-driven, get-me-out-of-here selling. AppLovin had essentially been priced for absolute perfection. So the second they deviated from their long history of constantly beating and raising guidance, the market punished them severely. In fact, year-to-date, the stock is now down roughly 54%. Facing this massive nosedive, AppLovin CEO Adam Ferrugi had to step in. He defended the company by calling it, quote, a model development timing issue. So the crucial point here is that management is saying, hey, this is not a demand problem. Ferrugi basically explained that the pace of meaningful AI model improvements was just lighter than normal during that one specific quarter. Even more importantly, he emphasized that a massive upgrade to the AXON model was actually deployed right after the quarter ended. Which brings us to Section 3, Wall Street's Great Divide, the downgrades and divergence. So did Wall Street actually buy management's explanation? Well, for some, the bearish pivot was immediate. Analysts over at Piper Sandler downgraded the stock from overweight to hold, and they dropped this fairly dramatic quote, "This quarter changed the story." For them, that flawless beat and raise narrative for this AI giant was officially broken. Goldman Sachs cut its target too, pointing to near-term timing challenges around those AI models. But if we zoom out and look at broader analyst actions, we see this massive tug of war. Yes, you've got Piper Sandler and Wells Fargo dropping their targets down to $325. But then look at Jefferies. They're maintaining a buy at $550. And UBS, they're forecasting a massive $790 price target. That implies a 158% upside from current levels. So despite all the scary headlines, the overall consensus among the 33 polled analysts actually remains a buy, with an average price target pointing to about a 70% upside. Let's explore why that is in Section 4, the bull case, growth catalysts and Shopify integration. Let's objectively pivot to why so many analysts are still totally bullish. One of the biggest catalysts coming up is their Shopify integration, which is expected to drive a huge e-commerce inflection in the second half of 2026. And this brilliantly illustrates the data flywheel they've built. Step 1, Shopify feeds AppLovin transaction-level data, stuff like adding to cart and checking out. Step 2, AXON uses that data to make way sharper predictions. Step 3, because predictions are better, campaign performance improves. Step 4, happy merchants spend more money on ads. And finally, Step 5, all that new conversion data feeds right back in to train the model even more. It's a perfect loop. And honestly, consumer advertiser spending already finished 28% above Q4 2025 levels, and Q4 is usually their seasonal peak. Beyond Shopify, the bulls have a few other rapid-fire catalysts to point to. For one, a major regulatory overhang is officially gone. The SEC closed its investigation into AppLovin's data collection without any enforcement action. Huge sigh of relief there. Plus, the underlying business is still an absolute cash machine, 88% gross margins and 53% revenue growth year over year. Oh, and they're actively buying back shares. They repurchased $551 million in stock during Q2, with a whopping $1.8 billion still left in their buyback authorization. But let's flip the coin. Section 5, the bear case, insider selling and slowing growth. We have to remain balanced here because a 28% drop does not happen in a vacuum, right? The bear arguments are actually very methodical and data-driven. First off, execution uncertainty. If AI model development is as unpredictable as Q2 suggests, future growth could be a pretty bumpy ride. Second, yes, growth is high, but it is decelerating. Revenue growth dropped from 85% in Q1 down to 76% in Q2. Third, and this is a big one, insiders are taking profits. Directors and executives sold roughly $154 million in shares last quarter alone. Toss in high stock volatility, it's got a beta of 2.54, meaning it's over twice as volatile as the broader market, and intense competition from tech titans like Google and Meta. Well, you can start to see why some investors are getting cold feet. Let's bring it all together in Section 6, valuation and outlook. Looking ahead to November. So how in the world do we reconcile these two totally competing narratives? Ultimately, it comes down to valuation and what's next. Despite the recent panic, analysts are still projecting massive growth for AppLovin. They're forecasting FY 2026 revenue to hit $8.12 billion. That's up from $5.48 billion in FY 2025, which represents a projected 48% revenue growth this year alone. Right now, the stock is trading at a forward PE of about 20. Bulls look at that and say, wow, that is incredibly cheap for a company growing in nearly 50%. Bears, on the other hand, argue that the slowing momentum completely justifies that multiple. It all sets the stage for a highly critical Q3 earnings call, which is expected around November 4th, 2026. The new AXON upgrade is live, the SEC cloud is gone, and soon the numbers are just going to have to speak for themselves. Which leaves us with the ultimate question you have to ask yourself about AppLovin's $20 million miss. Was this simply a temporary timing issue, like management claims, opening up a really rare buying opportunity? Or was it the first major signal of slowing momentum for a stock that was priced for absolute perfection? It is a highly contested debate, and one I absolutely encourage you to research further before making any investment decisions. Thanks so much for joining me on this explainer, and keep learning.